This is the Value Investor Podcast with Tracey. All things value, all the time.
Welcome back, value investors. So this week's episode marks basically the 1-year anniversary of the start of this podcast. So I wanted to thank everyone for tuning in to find out what's going on in the world of value stocks. You know I love the value stocks, so I'm going to continue bringing you value stocks every week going forward. But I did think this would be a good time to reflect on value investing basics. Now that I've been doing this year, it's good to go back and cover some of these just kind of regular topics about value investing to keep it fresh in our minds. So as you know, value investing isn't fancy. It looks for stocks that are being ignored by Wall Street, basically. And that usually means they have cheap fundamentals. Those two things usually go hand in hand. As an investor, you want to pay less for the earnings and for the sales. You want to get those things at a discount. So that's what we look for as a value investor. And we can use several different metrics to find the value stocks. The most commonly used one that I've covered on this show many times before is the price to earnings ratio, or PE, as it's commonly called. And this one is the one I use most often. I look for companies with forward PEs under 15. You can use whatever metric you want. 15 is kind of just the general level that most use. I've looked for ones under 10 to find like even cheaper stocks. So you can mess around with that. The S&P 500 is trading right now, I think around 18.5 to 19 times. So 15 is considerably under that. And so that's what I consider to be value. But some people get confused by the PE when they're looking at various financial sites. I've seen this and I get tweeted at about this a lot. So if you're on like Yahoo Finance or those kinds of sites and you're looking at the PE on there, a lot of times they use the trailing PE. And that's when you see that little designation, the TTM next to the PE. That looks at the past earnings. So I like to use the forward earnings, which is what looks at what might be happening in the next year or 6 months to a year, depending on what metric you're using. And I like to ask, what am I going to be paying for these earnings over the next 12 months? Now, there's no guarantee on those earnings because obviously they haven't reported them yet. So that's just looking at what the analysts believe the company is going to do over the next 12 months. But that's the metric I like to use for the PE. And now to narrow it even further and define even more value, you can add in some of the other ratios that we've also covered. First one would be PEG ratio, and that's the PE over the growth. Value investors normally look for PEGs under 1. Then you have the price to book, which is also, pretty often commonly deployed, but usually in conjunction with one of the other ratios. And that I look for a ratio under 3. That usually designates that a company is undervalued if it's under 3. And then there's a secret screening tool that far fewer people use, but you should think about deploying it. And that is the price to sales ratio. And that one, I also look for it being under 1. So if you have a price to sales ratio under 1, that means you're getting the sales of that company at a discount. So you are getting, well, let me just say, like if the price to sales ratio is 0.5, for instance, then for every dollar of sales, you're only paying 50 cents for that dollar of sales. And that's what I want. That's basically the sales are on sale. In other words, I'm paying less than what it's actually bringing in. So, and if it's over 1, say you have a price to sales ratio of 1.5 or 2, then I'm paying $2 for every $1 in sale. And if you stop and think about that, you're like, well, why would I want to do that? Why would I want to pay more than what the sale is giving me? So that's why a lot of value investors like to use the price to sales ratio. It's also one of the metrics that you probably shouldn't use just on its own because it can be a little finicky, I want to say. So with a lot of these, I wouldn't use just the single ratio. Probably with PE you can. I routinely use just PE as a ratio to search for value stocks, and I use PEG a lot on its own. But other than those two, if you're going to use price to book or price to sales, you should probably use it in conjunction with one of the other ratios so that you don't get the kind of weird distortions that you can get sometimes when you just use those two. But I was wondering, what if I screened for all the ratios? I used all of these classic value fundamental ratios, and then I added in the good Zacks rank or one of a 1, which is a strong buy, or a 2, which is a buy. Would I even get anything? I don't know. That's a lot of ratios. It's really going to make it very narrow if I look for value amongst all of these key fundamentals. And then I'm looking for the rising earnings estimates with that good Zacks rank. So I was a little scared about what I would get, but surprisingly, I did get 6 stocks. Yes, a big total of 6. But that kind of tells you how narrow the screen is. But these stocks would be what I consider to be classic value stocks if they have all of these ratios. So I screened for the PE, the price to book, PEG, and the price to sales, and then with the rank. And yeah, then I got the 6, and some of them are actually worth discussing. They're actually intriguing. So I'm going to give you 3 of the 6 here. You shouldn't be surprised that actually 3 out of the 6 are home builders. We shouldn't be surprised. I've done whole episodes on the home builders. They are classic value stocks right now with the growth component. So I'm going to talk about them again. I know you're going to get tired of me like, no, Tracey, not those home builders. But all the home building metrics still coming in very strong. There's still demand for new home construction. It's still well under where we were before the Great Recession. There's still a lot of household formations. Millennials, yes, I know everyone thinks they're still living in their parents' basement. They're not. They may be in apartments, but eventually they're going to want to buy a home, either a condo or a single family home. And they're getting to those ages now. Remember, the oldest millennials are 35 now. So yeah, they're going to want to buy houses. And yes, I know the debt issues and all of that with their student loans and things, but I don't believe it's going to be different this time. I do believe they're going to be buying. So that's a good future customer for all these home builders. So let's jump right into it. So the first one is KB Home. I've talked about them before, ticker KBH, and they have all the classic value fundamentals. So I'm just going to go over those. Their PE is 13.9, so they're cheap. Their PEG is 0.8. They have a price to book ratio of 1.1. Remember, we want to look under 3, so that's great. And then they have a price to sales ratio of the 0.5. So that's well under the 1. The PEG, as I said, was 0.8, and we do want to look under 1 for the PEGs too. So right there, you got all the classic values there. Zacks rank number 2 when I'm recording this. Oh, another thing on the rank, we're in the middle of earnings season. So some of these companies are going to be reporting, and so the rank may be changing. You may get a little bit of change on PE if they get a boost off of earnings reports. KB Home actually already reported, so we kind of know what they're doing. But the next stock I'm going to talk about, Pulte Homes, their ticker is PHM. They're actually reporting right after I record this. So I'm expecting a really good earnings report from them. All of the home builders have been giving the great earnings report, so I'm not concerned about that. But some of their metrics are going to change. But right now, Pulte's metrics, and I've talked about them on the podcast before, they are really cheap. They're among the cheaper of the home builders, and Pulte is the largest home builder in the country. So if you want to just get the most diversity across geographic regions, this is the one you want. Their PE is just 10.9. They have the PEG of 0.7. Remember, we want under 1, so that's a good one there. Price to book is 1.6. We want under 3. And price to sale is right on the cusp, so they just barely are getting in here before their earnings, at least, of 0.98. So they're in there, and they're number 2 right now. That may change. Might see boost up to number 1 if this earnings report is as good as what I'm thinking it's going to be. So Pulte Homes, PHM, there's like I said, 3 out of the 6 are home builders, but those are just the 2 I picked. I like almost all the home builders right now, except maybe Hovnanian. I would kind of stick away from them, but everyone else, good times for the home builders. And then the third stock is, yes, the dreaded retail. I was kind of surprised at the one that showed up in here, but it's got all the value fundamentals, and Wall Street and investors hate these. So it's a department store. It's JCPenney. JCP is the ticker. And, it's been struggling for several years. I've had these arguments with my work colleagues, including Dave Bartosiak. He thinks they're doomed. He thinks no one's going to the mall ever again. And I don't actually. They weren't profitable the last couple of years, but they eked out profit last year, just barely. They made 8 cents a share, and this year they're supposed to make 48 cents a share. So it's taken them a couple of years, but they finally are back into the green, which is why we get the PE ratios and all of that. Remember, if you don't make any money, you don't have a PE. So if you see those companies that are, NA in the PE, that's because they're not profitable. So we want profit. Their PE ratio right now is 10.5. Their PEG is just 0.6, so they do have some growth, big earnings growth this year, as I said, 48 cents versus 8 cents a year ago. Price to book is just 1.3. Price to sales ratio is 0.1. That's almost, I'm getting the sales for almost nothing here. So, but again, you are buying a department store. So we all know the dangers in what's going on in that sector. It's similar to all of them. But a lot of these stocks have really sold off, and a lot of people think they're all going under, but they're not. And as an investor, you really have to look at the fundamentals of the company, and certainly as a value investor, because you're not following the herd as a value investor. You're just going out of the mainstream. So I wouldn't say the home builders are out of the mainstream right here, but no one on the street is really paying attention to them. That's why I had that prior podcast about how the hottest sector on the street a couple weeks ago was the home builders. They were outperforming even some of the FANG high growth stocks year to date. They've kind of slowed down a little bit recently, but they've had really good performance year to date. And most investors aren't caring about housing right now or the home builders. So that makes them an opportunity with their rising earnings here. And it also makes retail an opportunity if you have the guts to go in there. Not all retail is going to survive, as we've seen. There's been a lot of bankruptcies this year. So you really have to do your homework on that area. And just because you got these low ratios for JCPenney doesn't mean you shouldn't be investigating further. And I really recommend people listen to the conference calls if you can, or you can get the transcripts on Seeking Alpha and other websites. But really listening to it is even better than the transcripts, because the conference call, you can hear inflections of the voices. You can hear them get mad at certain questions. You can hear the excitement in their voice if things are going really well. So anyone can tune in, and they have the recorded versions if you can't do it live on their websites. You can go and listen to it. So I definitely recommend checking in with the conference calls on all these companies. So again, the tickers for this week are KB Homes, KBH, Pulte, PHM, and JCPenney, JCP. And you can listen to all of our old podcasts, including the one on the home builders that was a little bit earlier this year on SoundCloud. You can subscribe over there. And you can also find us on iTunes, of course, on Apple Podcasts. And we have our own page on iTunes now. So you can find us easily under the Value Investor Podcast there and subscribe there. Or you can still get us with the Zach's Market Edge podcast, and you can get both podcasts and enjoy both of those. So again, I thank you for a year's worth of episodes, and we're going to keep on rolling here and finding more value stocks. And I'll see you again next time.